The ability to decipher the true intentions of large market operators is the cornerstone of consistent trading success, a principle meticulously developed by Richard Wyckoff. At the dawn of the 20th century, Wyckoff emerged as a pioneer in technical analysis, a visionary who sought to demystify the seemingly chaotic movements of financial markets. His profound contributions laid the groundwork for understanding market behavior not as random noise, but as a deliberate interplay of supply and demand, driven by well-orchestrated campaigns. Wyckoff's method, rooted in the meticulous analysis of price and volume, offers a timeless framework for navigating the complexities of trading and investing, remaining remarkably relevant for modern traders and investors across all asset classes and timeframes. This comprehensive guide will unveil 7 simple yet powerful steps designed to empower any beginner to master the Wyckoff method, transforming their market perspective and enhancing their trading decisions. Each step builds upon the last, constructing a robust understanding that moves beyond mere indicator following to genuine market insight. The journey begins with Step 1, understanding Wyckoff's composite man. This foundational concept is central to the entire Wyckoff methodology, providing a lens through which to interpret all market action. The composite man is an imaginary, powerful operator who represents the collective actions of the largest institutional players, often referred to as smart money. This entity is not a single individual, but a personification of the well-funded, highly informed entities that possess the capital and influence to move markets. The primary objective of the composite man is straightforward yet profoundly impactful: to accumulate assets at low prices, often when retail sentiment is at its most pessimistic, and subsequently to distribute those assets at high prices, typically when public optimism is at its peak. This strategic accumulation and distribution are not random events. They are carefully planned campaigns executed over extended periods. The actions of the composite man directly influence market movements, creating the very trends and trading ranges that traders observe on their charts. By understanding this concept, one begins to see how the smart money manipulates market psychology, often luring retail investors into buying at the top or selling at the bottom. This manipulation creates the classic patterns of fear and greed that characterize market cycles. Analyzing the market from the perspective of the composite man is paramount for making informed trading decisions. It shifts one's focus from reacting to price fluctuations to anticipating the next strategic move of the dominant players. Instead of being a victim of market manipulation, one learns to identify and align with the direction of the smart money, thereby enhancing the probability of successful trades. This initial step is less about technical indicators and more about adopting a strategic mindset, recognizing that behind every significant market move, there is a deliberate, calculated force at play. It compels the observer to ask, what is the composite man doing here? Is he accumulating or is he distributing? This question becomes the guiding principle for all subsequent analysis. Step 2 delves into the 3 fundamental laws of Wyckoff, which serve as the bedrock of his entire analytical framework. These laws are not mere observations. They are universal principles governing market behavior, providing a logical basis for understanding price and volume relationships. The first is the law of supply and demand. This law states that prices rise when demand exceeds supply and fall when supply exceeds demand. It is a fundamental economic principle applied directly to market analysis. When the composite man is accumulating, demand gradually increases, absorbing available supply, leading to eventual price increases. Conversely, during distribution, increasing supply overwhelms demand, causing prices to decline. To apply this law, one must compare price and volume bars. A large price movement on high volume indicates strong underlying forces: high demand pushing prices up or high supply pushing them down. Conversely, a small price movement on high volume suggests a struggle and absorption of supply or demand, indicating an impending change or continuation depending on the context. The true art lies in discerning the balance. Are buyers in control, or are sellers dominant? This comparison of effort, volume, and result price movement is crucial. The second fundamental principle is the law of cause and effect. This law posits that every market movement or effect must have a preceding cause. In Wyckoff's framework, the phases of accumulation or distribution represent the cause, and the subsequent price movements, whether upward, markup, or downward, markdown, are the effect. A period of extensive accumulation builds up a significant cause, which then fuels a substantial effect in the form of a sustained upward trend. Similarly, a prolonged phase of distribution creates the cause for a subsequent downward trend. Wyckoff emphasized the use of horizontal charts, such as point and figure, P and F, charts, to measure the cause built within a trading range. By counting the number of columns in a P and F chart during accumulation or distribution, one can estimate the potential magnitude of the subsequent price move, thereby forecasting potential price targets for the effect. This law provides a logical framework for understanding trend duration and magnitude, reinforcing the idea that market movements are not random, but are the consequence of prior preparation by the composite man. The third law is the law of effort versus result. This principle examines the relationship between volume, which represents the effort expended by market participants, and the price movement, which is the result of that effort. In a healthy market, effort and result should be in harmony. High volume effort should lead to significant price movement result in the direction of the trend. Conversely, low volume should correspond to minor price changes. When there is a divergence between effort and result, it signals a potential change in trend or a weakening of the current trend. For instance, if prices are rising on decreasing volume, it suggests that the effort to push prices higher is diminishing, indicating that the result, the uptrend, may soon falter. Similarly, if prices are falling on very low volume, it implies that selling pressure is not strong, and the downtrend might be nearing its end. The appearance of high volume with little price progress often indicates absorption of supply during accumulation or absorption of demand during distribution, acting as a warning sign that the prevailing trend is losing momentum, and a reversal may be imminent. This law is critical for identifying potential trend exhaustion and anticipating shifts in market dynamics before they become obvious to the broader market. The principle we have just discussed is a powerful tool in your analytical arsenal, but to apply it with the conviction of a professional, you need to understand the judgment that forged it. That judgment is the very heart of Richard Wyckoff's masterwork, How I Trade and Invest in Stocks and Bonds. This book is not a dry technical manual. It is the record of a 33-year career on Wall Street. Inside, Wyckoff shares his own campaigns, detailing the logic behind his profitable trades and long-term speculative investments. He dissects the methods of other market titans, analyzing the principles of legendary operators like Jesse Livermore, E.H. Harriman, and James R. Keene. You will learn his practical methods for building a defensive portfolio, his hard-won rules on the dangers of averaging down, and above all, the ultimate skill: how to develop independent, forward-looking judgment. The best way to access this timeless wisdom is through the modern adapted edition by Max Davidson. Its annotations act as your personal guide, translating the historical context for today's markets. If our videos teach you the what, this book teaches you the how and the why. The link is in the description. Step 3 introduces the 4 distinct phases of Wyckoff's market cycle, providing a high-level overview of how prices move through predictable stages. Wyckoff observed that market movements are inherently cyclical, not linear, and these cycles can be broken down into 4 distinct phases that repeat over time. Understanding these phases allows one to anticipate the general direction of prices and position oneself accordingly. The first phase is accumulation. This phase typically occurs after a prolonged downtrend, where the composite man begins to quietly buy up assets from weak hands. It is characterized by a stable trading range, often appearing as a sideways movement on the charts. During accumulation, large institutional players are building their long positions, absorbing the supply offered by retail investors who are exiting the market due to fear or frustration. Price volatility tends to be low, and volume may show signs of increasing on rallies and decreasing on dips, indicating absorption. This phase is designed to acquire a substantial amount of shares without significantly driving up the price, preparing for the next upward move. Following accumulation is the Meike markup phase. This is the period of rising prices, where the composite man has successfully accumulated a significant position and now begins to actively push prices higher. Demand starts to overwhelm supply, leading to a noticeable upward trend. This phase is characterized by higher highs and higher lows, with strong price movements often accompanied by increasing volume. The smart money is now actively encouraging retail participation as the rising prices attract public attention and generate optimistic sentiment. This is where the effect of the previous accumulation cause becomes evident, and the market delivers substantial returns to those who entered during the accumulation phase. After a significant markup, the market enters the distribution phase. This phase is the inverse of accumulation, occurring after a prolonged uptrend when the composite man has reached their price targets and begins to sell off their accumulated positions. Similar to accumulation, distribution is characterized by a sideways trading range. However, during distribution, institutional players are gradually offloading their shares into the hands of an eager public, whose optimism is at its peak. Volume patterns may show increasing activity on declines within the range and decreasing activity on rallies, signaling that supply is beginning to overpower demand. The smart money is strategically exiting their positions without causing a significant price drop, preparing for the subsequent decline. Finally, the market enters the markdown phase. This is the period of falling prices where the composite man has successfully distributed their holdings, and selling pressure now dominates the market. Supply overwhelms demand, leading to a noticeable downward trend. This phase is characterized by lower highs and lower lows, with strong price movements often accompanied by increasing volume, especially on declines. Fear and panic begin to set in among retail investors, leading to further selling and accelerating the downtrend. This is the effect of the previous distribution cause, and it often leads to substantial losses for those who bought late in the distribution phase. Understanding these four phases provides a crucial roadmap for anticipating market direction and aligning one's trades with the cyclical nature of price movements. Step 4 focuses on the intricate details of analyzing trading ranges, specifically the accumulation schematics. A trading range, in Wyckoff's view, is not merely a period of sideways price action. It is a battleground where the composite man systematically accumulates or distributes assets. During accumulation, the trading range represents the cause that will lead to the effect of a markup. Identifying and understanding the key events within these schematics is crucial for pinpointing high-probability entry points. The typical accumulation schematic unfolds with several distinct events. It often begins with preliminary support, PS, where substantial buying begins to emerge after a significant downtrend, indicating that prices are approaching a level where demand is starting to overcome supply. This is followed by a selling climax, SC, a dramatic event characterized by extreme selling pressure and panic, often accompanied by very high volume. This is usually the point where weak hands capitulate and the composite man absorbs a massive amount of shares. Immediately after the SC, an automatic rally, ARs, occurs as the intense selling pressure subsides and the remaining demand pushes prices up quickly, forming the upper boundary of the initial trading range, a secondary test, ST. Then follows where prices retrace back towards the SC area, often on lower volume, to test the strength of the demand. This test helps confirm that the selling pressure has indeed subsided. The phase of accumulation then progresses, often with multiple STS, creating a period of consolidation. A particularly significant event in accumulation is the spring. A spring is a price move below the established support level of the trading range, which quickly reverses back into the range. It represents a shakeout or a bear trap, where the composite man attempts to trick remaining weak holders into selling their shares, while simultaneously testing for any lingering supply below the support level. A successful spring will often occur on relatively low volume during the downward thrust, with strong volume on the subsequent recovery, indicating that supply has been exhausted and demand has quickly reasserted control. The spring is often considered a critical signal for entry, as it suggests the completion of the accumulation process and the imminent start of the markup phase. The significance of volume in each phase of accumulation cannot be overstated. High volume during the SC, followed by diminishing volume on subsequent tests, and then increasing volume on the rally after a spring, all serve to confirm the actions of the smart money. By meticulously analyzing these events and their associated volume signatures, one can identify the opportune moments to enter long positions, aligning with the composite man before the significant markup occurs. Step 5 mirrors the previous step but focuses on the distribution schematics, which are equally critical for identifying potential market tops and initiating short positions. Just as accumulation builds the cause for an uptrend, distribution builds the cause for a downtrend. Understanding the events within these schematics allows one to recognize when the composite man is offloading assets and preparing for a markdown. A typical distribution schematic also unfolds with several distinct events. It often begins with preliminary supply, PSY, where substantial selling begins to emerge after a significant uptrend, indicating that prices are approaching a level where supply is starting to overcome demand. This is followed by a buying climax, BC, a dramatic event characterized by extreme buying pressure and euphoria, often accompanied by very high volume. This is usually the point where the public rushes in, buying aggressively, while the composite man sells into this strength. Immediately after the BC, an automatic reaction, AR, occurs, as the intense buying pressure subsides and the remaining supply pushes prices down quickly, forming the lower boundary of the initial trading range. Secondary test, ST. Then follows where prices retrace back towards the BC area, often on lower volume, to test the strength of the supply. This test helps confirm that the buying pressure has indeed subsided. The phase of distribution then progresses, often with multiple STS, creating a period of consolidation. A particularly significant event in distribution is the upthrust UT, or upthrust after distribution UTAD. An upthrust is a price move above the established resistance level of the trading range, which quickly reverses back into the range. It represents a bull trap, where the composite man attempts to trick remaining optimistic buyers into entering long positions, while simultaneously testing for any lingering demand above the resistance level. AUT or UTAD will often occur on relatively low volume during the upward thrust, with strong volume on the subsequent decline, indicating that demand has been exhausted and supply has quickly reasserted control. The UT or UTAD is often considered a critical signal for entry into a short position, as it suggests the completion of the distribution process and the imminent start of the markdown phase. The significance of volume in each phase of distribution is paramount. High volume during the BC, followed by diminishing volume on subsequent tests and then increasing volume on the decline after a UT or UTAD, all serve to confirm the actions of the smart money. By meticulously analyzing these events and their associated volume signatures, one can identify the opportune moments to enter short positions, aligning with the composite man before the significant markdown occurs, thereby protecting capital and potentially profiting from declining prices. Step 6 outlines Wyckoff's comprehensive 5-step approach to the market, a systematic method for applying all the previously discussed principles to make informed trading decisions. This approach moves beyond simply identifying patterns. It provides a structured process for analyzing the market from macro to micro, ensuring all relevant factors are considered. Step 1. Determine the market's current position and probable future trend. This involves assessing the overall market trend using the law of supply and demand. Is the broad market in an uptrend, downtrend, or trading range? One must look at major market indices, like the S&P 500 or NASDAQ, and identify whether accumulation or distribution is underway at a larger scale. This macro-level analysis provides the context for individual stock selections. If the overall market is in a strong uptrend, it is generally safer and more profitable to look for long opportunities in individual stocks. Conversely, a strong downtrend suggests focusing on short opportunities. This step emphasizes understanding the prevailing tide before attempting to navigate individual waves. Step 2. Select assets that are in harmony with the current trend. Once the overall market trend is established, the next step is to identify individual stocks or other assets that demonstrate comparative strength or weakness relative to the market. In an uptrending market, one would seek stocks that are outperforming the index, showing stronger accumulation or already in a markup phase. In a downtrending market, one would look for stocks that are underperforming, showing signs of distribution or already in a markdown phase. This comparative analysis helps to filter out weaker candidates and focus on those with the highest potential for movement in the desired direction. A stock that is accumulating while the market is also accumulating, or beginning its markup while the market is in markup, presents a higher probability setup. Step 3. Look for signs of accumulation or distribution. This step involves drilling down into the chosen assets and applying the detailed analysis of accumulation and distribution schematics discussed in steps 4 and 5. For a long position, one would seek clear evidence of accumulation within a trading range, identifying events like the selling climax, automatic rally, secondary tests, and especially the spring. For a short position, one would look for signs of distribution, identifying events like the buying climax, automatic reaction, secondary tests, and the upthrust after distribution. This systematic identification of the cause is paramount for anticipating the effect. Step 4. Determine the asset's readiness to move. Having identified a potential accumulation or distribution pattern, the next crucial step is to assess if the asset is truly ready to initiate its markup or markdown phase. This involves a meticulous analysis of the specific Wyckoff phase within the schematic and the associated volume patterns. For accumulation, one would look for signs of supply exhaustion, such as diminishing volume on tests of support and increasing volume on breakouts from the trading range. The spring, followed by a low volume test of the spring, is often a strong indicator of readiness. For distribution, one would look for signs of demand exhaustion, such as diminishing volume on rallies within the range and increasing volume on breakdowns. The UTAD, followed by a low volume test of the UTAD, often signals readiness for a markdown. This step is about timing, ensuring that the cause is fully built and the market is primed for the effect. Step 5. Determine entry points and establish stop losses. The final step involves precise execution. Using the identified Wyckoff events, such as a spring for long entries or an upthrust after distribution for short entries, one can pinpoint exact entry points with favorable risk-reward ratios. Once an entry is made, it is imperative to immediately establish a stop-loss order. For a long position entered after a spring, the stop-loss would typically be placed just below the low of the spring. For a short position entered after an UTAD, the stop-loss would be placed just above the high of the UTAD. This disciplined approach to stop-losses is fundamental to risk management, ensuring that potential losses are limited, protecting capital and allowing for consistent application of the strategy. This 5-step approach provides a robust framework for systematic decision-making, moving from broad market analysis to precise trade execution. Step 7 addresses the critical aspects of Parikjar, trade and risk management. Within the Wyckoff framework, emphasizing that even the most insightful analysis is incomplete without disciplined execution and capital preservation. Wyckoff himself stressed that proper trade management is just as important as accurate market analysis. The first and foremost rule in managing trades is the importance of establishing stop losses to limit risks. A stop-loss order is not a sign of weakness. It is a vital tool for survival in the markets. Before entering any trade, one must determine the maximum acceptable loss and place a stop-loss order at that level. This ensures that if the market moves contrary to expectations, the loss is contained, preventing catastrophic drawdowns. For Wyckoff traders, stop-losses are typically placed logically, just outside the boundaries of the accumulation or distribution patterns. For example, after a long entry following a spring, the stop-loss might be placed just below the spring's low, as a break below this point would invalidate the accumulation thesis. Similarly, for a short entry after an UTAD, the stop-loss would be placed just above the UTAD's high. Determining target prices is another crucial element, and Wyckoff's law of cause and effect provides a powerful methodology for this. As discussed, the cause built during accumulation or distribution can be measured using point and figure P&F charts. By calculating the horizontal count of the P&F chart within the trading range, one can project potential price targets for the ensuing markup or markdown phase. This objective method helps to set realistic profit targets, preventing premature exits from profitable trades or holding on to trades for too long when the effect has largely played out. These targets provide a roadmap for managing the trade through its lifespan. Strategies for managing positions and taking profits are equally important. As a trade moves in the intended direction, one might consider trailing stop losses to protect accumulated gains. This involves moving the stop loss higher for long positions or lower for short positions as the price advances, ensuring that a portion of the profit is locked in. Wyckoff also advocated for partial profit-taking at intermediate targets, allowing the trader to reduce risk while still participating in further potential moves. The decision to take full profits or scale out depends on the strength of the trend, the remaining potential based on P&F counts, and the overall market context. It is a dynamic process that requires continuous monitoring and adjustment. Finally, Wyckoff placed immense value on discipline, patience, and capital management. The Wyckoff method is not a get-rich-quick scheme. It requires patience to wait for the optimal setups, discipline to stick to the rules, and sound capital management to ensure longevity in the markets. Over-leveraging, chasing trades, or deviating from the established plan are common pitfalls that Wyckoff warned against. Consistent practice and diligent analysis of charts across different time frames are indispensable. One must continually study historical charts, applying the Wyckoff principles to understand how accumulation and distribution patterns unfolded in various market conditions. This continuous learning and refinement of one's judgment are what truly transform a beginner into a professional Wyckoff trader. The method is a lifelong study, demanding dedication, but offering profound insights into the underlying mechanics of financial markets. In conclusion, the Wyckoff method stands as a testament to the enduring power of systematic market analysis. Richard Wyckoff's pioneering work, centered on the profound relationship between price and volume, offers traders and investors a structured, logical framework for understanding market behavior. Its core advantage lies in its ability to provide a deeper comprehension of market psychology, allowing one to anticipate the movements of the composite man, rather than merely reacting to them. By mastering the 7 simple steps, understanding the composite man, applying the 3 fundamental laws, recognizing the 4 market phases, meticulously analyzing accumulation and distribution schematics, following the 5-step approach to the market, and diligently managing trades and risks, individuals can significantly enhance the accuracy and profitability of their trading decisions. Despite its origins in the early 20th century, the principles of the Wyckoff method remain remarkably pertinent and effective in today's dynamic financial markets. It is not just a set of rules. It is a philosophy that cultivates patience, discipline, and independent judgment. We encourage all aspiring traders and investors to delve deeper into these principles, to practice diligently, and to integrate this powerful methodology into their analytical toolkit. The journey from beginner to professional is a challenging one, but with the insights provided by Wyckoff, the path becomes clearer, leading to a more informed, confident, and ultimately successful trading career. Embrace the wisdom of Wyckoff and transform your understanding of the market.